We're half an hour away from the open in Hong Kong. Markets are shut on the mainland. You're watching The China Show. I'm Yvonne with David Ingles.
Let's get your top stories today. Former President Trump is safe after what the FBI is calling an apparent assassination attempt. The suspect is in custody and investigations are ongoing. Now, pessimism over the Chinese economy deepens with data over the weekend showing factory output, consumption, and investment for August all slowing, as you can see, more than forecast. But the spotlight this week is firmly on the Fed and that rate decision on Wednesday, with markets watching closely for signals of a 50 basis point rate cut.
Happy Monday. It is looking to be a pretty busy week, but so far, just keep in mind, a lot of key major markets are shut today. So Japan and China are certainly in the mix across that. So we're watching the ex-Japan gauge here this morning. We're seeing equity slightly tilted to the upside here with the likes of Taiwan coming online there as well. Singapore, though, that one is slightly lower. Although we talk about that flood of money, I think it's been 5 straight weeks now. We've seen inflows into Southeast Asia. Some of these smaller markets getting a bit more of a spotlight now as the Fed gets closer to possibly cutting rates as early as this week, right? So that's what the market is primed for. We talk about, I think it's a 70% chance that we might be actually seeing a 50 basis point cut this week. We'll see if really that's the case. But it's a 36-hour rate rush, whether it's a decision deluge, monetary policy roller coaster, whatever you call it. It's going to be pretty busy once the Fed starts on Wednesday. We got the BOJ as well as the BOE to wrap up the week as well. Dollar yen still trading a little bit on the stronger side at 140 here this morning. Keep in mind, with Japan markets shut, treasuries are not trading here in the Asia session. But you are seeing bond yields in Australia at least ticking slightly lower here this morning. Brent's slightly catching a bid here. We're watching Bitcoin in particular. U.S. futures have been pretty steady. The dollar as well. After we've been covering and tracking what's been going on and what they're calling the second assassination attempt of the former President Trump over the weekend. Bitcoin, though, did take a bit of a dip. Not sure if that's related, but we're seeing that cryptocurrency down some 2% right now. You take a look when it comes to the approach to China. So it was a weekend of data that you had to digest, right? Whether it was the credit numbers that first came, you have that rare sort of statement from the PBOC shortly after, and then the data dump, which basically all major indicators did show that things were slowing down and missed expectations in August. You follow that with new home prices as well. All that doesn't bode well, but China is shut, keep in mind. So Hong Kong might be feeling the brunt of this today. Futures are slightly negative, 709 for the currency, as we mentioned. So it's mainland China, it's South Korea, Japan, Bangladesh, Indonesia, Malaysia, Sri Lanka, all of which are closed today. Dave. Yeah,
so volumes are expected to remain low, and we haven't also mentioned as well that you have the strongest typhoon set to hit Shanghai, if not already, in 75 years. So lots of big stories we're tracking today as well. And of course, back to our top story right now. And if you're just joining us right now and just learning about this, former President Donald Trump is safe after what the FBI is calling an apparent assassination attempt at his golf course in West Palm Beach in Florida. Now, the person believed to be connected to the incident was taken into custody in a neighboring county.
We have somebody in custody right now that is a potential suspect. We got a little bit more work to do on it, but as we usually do, as soon as we decide that we're going to book him into the county jail and the charges that he's going to be booked into, we'll get those to you and we'll get a picture of him and we'll get you his background.
Let's get a latest from our managing editor for the Weekend News in the Americas, John Edwards, joining us right now. John, a pleasure to have you on the show, and good Monday morning from the Asia Pacific. What do we know exactly about what happened?
Yes, so authorities have told us that the president was golfing around 1:30 this afternoon. The usual practice is that the Secret Service is a hole or so ahead of him to sort of create a moving bubble, make sure that he's fully protected. A Secret Service agent spotted a person in the bushes outside the fence near the golf course, and saw the head of a rifle coming out of the bushes. The agents fired on that person, who dropped his rifle, ran away. drove his car to a neighboring county where he was later apprehended. We are reporting, as are other outlets through sources, that the suspect is Ryan Routh, a 58-year-old man from Hawaii. Trying to find out more about him, but he is the person in custody, according to law enforcement sources we've spoken with.
And John, I mean, this is already the second assassination attempt we've seen on the former president in 2 months or so. It's already become a very chaotic sort of presidential campaign. Does this change the dynamics in any way this time around? Yeah,
I mean, it certainly shifts attention away from what had been a large run of momentum for Democratic candidate Kamala Harris, and sort of upends the race in that sense. The narrative had, of course, been about the very difficult debate that President Trump had against Vice President Harris last week, and it's now going to shift attention to this, latest incident, which is, likely to raise some sympathy for the former president. It remains, of course, to be seen how much of a lasting effect this will have. The previous attempt in July on the former president's life didn't really move the polls in a lasting way, given that the upheaval of President Biden dropping out and Vice President Harris joining the race, sort of superseded that. So we'll see in this instance if, now it's a second incident, if this has more of a lasting impact.
John, thank you so much for getting us up to speed there. John Edwards, our managing editor for Weekend News in the Americas there, giving us an update of that attempted assassination attempt on the former president. To our other top story on the weekend, and a flurry of economic data showing that the economic situation in China might be worsening. Most, if not all, major metrics missing forecasts, putting the government's full-year growth target of about 5% in jeopardy. Here's a look at some of the numbers as well. And we just talked about this. Goldman Sachs and Morgan Stanley have both come out on the back of those numbers and slashed their own forecast on the Chinese economy. Stephen Ingles, Chief North Asia correspondent, is here with us to talk us through how bad these numbers are in context. Steve.
Don't forget Citi. They also downgraded this morning as well, down to 4.7%.
Okay.
So Morgan Stanley to 4.6%. Also Goldman Sachs to 4.7%. So that kind of is in line with the growing consensus that the Chinese economy will not meet the government's growth target for this full year, as we're running out of time, of around 5%. I guess you could say 4.7 is around 5%, but it's to the downside, obviously. And again, these economists are saying, for Morgan Stanley, essentially saying there's this worsening debt deflation loop likely to outweigh potential easing measures. There is a growing chorus for more easing, but how much is the big question as well. So the numbers are industrial production, 4.5%. It equals the weakest growth in factory output since July of last year. It's also 4 consecutive months now of decelerating growth in factory output. Had been a bit of a strength because of on the back of exports and also excess industrial capacity, while property and consumption has been weak. Factory output has been okay, but look at that. That is actually the longest streak of decelerating growth in factory output since September of 2021. So that really drives home that point. Retail sales, I talked about the consumer. They're holding on to their renminbi, obviously. This is the 5th or 6th consecutive month of single-digit growth, 2.1%, missed estimates. Also, fixed asset urban investment, 3.4%. That also missed estimates. Again, so your move now, authorities, to see what they can do to shore up confidence in what has been weakening confidence.
I'm guessing there's a lot of economists out there that are or at least talking about the urgency for more stimulus now. What are you hearing?
Yeah, absolutely. I mean, they've had a string of rate cuts. They've had mortgage easing, but it hasn't been the big bazooka. And that's something that Raymond Jeong, a chief China economist at ANZ Bank, says the August data basically rules out the chance of basically hitting that official target, unless the top leadership is willing to launch a bazooka, his words, a stimulus package. We've had no indication that we're getting any kind of bazooka, landmine, or any kind of howitzer, or any kind of military weaponry to boost this confidence, because there is entrenched structural weakness, obviously, and property is a main drag. So what can they do? Well, most economists expect to see further rate cuts, perhaps triple R cuts as well. Last year, remember, they had a ad hoc kind of special budget to kind of boost some spending. Yeah. That's something they could do at the provincial level as well, to give, because the provinces right now are not spending. Their fiscal coffers are kind of dry. So there are things to do, but we're running out of time, essentially.
Yeah, we're moving into the fourth quarter soon. And to your point, there are a lot of bottlenecks out there that they have to work through as far as economic transmission of economic policy. Steve, thank you so much. Stephen Engel, Chief North Asia correspondent there. Just ahead on shows, we'll be joined by the global head of Citi for Wealth. Andy Sieg joins us in a couple of minutes to talk us through his plans for the region, hiring plans, if at all, of course, and some of the big opportunities they see, of course, this part of the world. Joins us, of course, later this hour.
But up next, we're looking ahead to a big week of central bank decisions, with investors split on the Fed's next move on rates. We have AXA Investment Managers Ecaterina Bigos joining us for some analysis. And we're counting down the open of trade in Hong Kong. Just today, mainland markets are shut as we brace, of course, for this typhoon just as we're about to hit the Mid-Autumn Festival. This is the China Show. Happy Monday. All right, the week is finally here when it comes to the Fed, of course, as they're going to take the spotlight first. But really, you take a look at the slew of rate decisions we're expected to hear, not just in the BOE or as well as the BOJ, but also in South America. You talk about South Africa, Taiwan, Indonesia, and that LPR to wrap up the week as well, Dave. Yeah,
and to your point, right, a lot of it comes down to a lot of these central banks and what they do and how they say it will depend on what the Fed does and how they say it. And you look at pricing right now. We ended the Friday session in the Fed Fund futures market at 50-50 for a 50. That probability has now gone up ever so slightly by about 15 to about, let's call it base case now is 50. So the Fed better deliver 50, or do they deliver 25 and give some guidance? Just for context, too, the last time they had a dissenting vote, based on memory here, was back in 2022. I think it was Esther George who voted against a 75 basis point hike. They went by 50, I think, at that point in time. So do we get divisions within the FMOC and how they frame that? Let's bring in Ekaterina Bigos, CIO for Asia ex-Japan at Core Investments at AXA Investment Managers. It's nice to see you and good morning.
Good morning.
With the information that we have now, does the Fed need to cut by 50 at this point? Or what is the best thing that they could do?
I think this is the most undecided market probabilities that we've seen, a 50-50. It's been unusual into coming so close to the Fed decision. And I think this has largely been driven. First, we had the CPI data, which was given us indication that inflation is coming to target, but is not at target. I think this is very important to understand. And then we've had, of course, a few news reports that has derailed some of that market expectations to expecting a 50. But again, the market is quite divided. And the reason that we've seen such a division is that the 50 is not in the data at the moment. If you look at all the data that's coming through, we have the estimate of GDP Atlanta now, which is at 2.5 GDP estimates, which is very healthy. But we've had ISM data. And also, if you look at the labor market, we still have the wages that are healthy or resilient. And also, there is a healthy job creation. So we haven't seen a negative print yet in payroll. So I think, broadly, I think 50 is not in the data. You could say that Fed might decide to front load, but this is, again, there's no need for this at the stage as we see it. I think more likely will be a 25 with a good guidance or dovish guidance into the year end, with, again, signs or indications that they would move with 50 if the data comes weaker into the next data prints.
And what is the narrative now? I mean, is it the fact that if they do cut by 50, that would send a bit more panic to these markets? Or do you think traders are basically convinced themselves that this is actually a good thing for markets?
Yeah, it seems that by the way the markets are opened, the traders have convinced that 50 is a good thing. Whereas before, of course, a 50 would indicate the Fed is potentially behind the curve, or indicates that they maybe know some data or weak data that hasn't come through, and they need to cut by 50 basis points. I think the market is obviously wanting for the financial conditions to ease. But again, one point to highlight here that, yes, Fed is important when it comes to broader market, but financial conditions are more important when it comes to growth, right? So we need to be cognizant that financial conditions have eased. We've had market that rallied, again, volatility, but we've had a strong market performance. Credit spreads have tightened again. So again, financial conditions, taking that spectrum of Fed, equity markets, and where credit spreads are, it is tight. It have eased. So again, it doesn't give much room, considering that financial conditions ease. Data is strong. For them to come at 50 basis points, again, will be unusual.
And for investment strategy, is it, in terms of portfolio construction, do I lean more into risk right now? Is it time to stay more cautious? How does the fourth quarter look like effectively?
Yeah, I think for us, we're still staying somewhat cautious. We're starting to get constructive on risk assets, but it's too early because we're coming into seasonality again towards year end. We're also coming into elections, will bring volatility. And we do still have a little bit of undecided or cautiousness around the growth. Again, some of the data acts of lag, as we know. So the market will be watching very closely growth and where growth is taking from here. So I would say as we come into the year, and we need to be preparing for risk, but taking too much risk into lower quality, I would say, across the spectrum, whether that's credit or into the equities, where smaller cap, I think it's premature, and we've seen the market taking the initiative again to rally in the small cap. But into the year end, we still prefer quality. We still prefer strong balance sheets that we think will stay more resilient. When we look at credit, we prefer credit that has carry. If we look at places like emerging markets, of course, in credit, high yield specifically has a stronger carry that we think will keep the markets, or will keep the asset class into positive territory or probabilities, or provide a downside somewhat protection because of that carry element of it. Yeah.
What do you make of what we saw back in August, right, when we started to see more of the BOJ also chiming in and hiking rates for the first time, and the ructions that we saw across these markets? There's many that on the show that say, we've seen the worst of it. But that yen carry trade, could it come back in still a big way?
Yeah, and I would say the BOJ would be more cautious from here, and we've seen indications with that regard. Part of it, again, we've seen some news reports to say that some of that carry trades has unwind. But of course, we're in a very sensitive period where monetary policies are adjusting, BOJ coming from this longer commodity monetary policy, which is not a straightforward exercise. And I'd say cautiousness is important, not because just of the market, but also because of the consumer, the corporates that obviously have leverage that is floating rate. And I think the BOJ will be cognizant of not disrupting the economic growth that is emerging, but is not yet ingrained. So again, and also the inflation, we've seen it emerging, but again, not yet to the level where BOJ would like to see it. When it comes to, again, other risk sensitivities, of course, look, I think the biggest concern for the market will be from here will be growth. Any signs that the growth is decelerating for the U.S. will have repercussions on global markets because, of course, the resilience that we've seen in Asia as well, the support for exporters is being driven partially because U.S. has stayed more resilient. So the exporters have benefited. Japan has benefited for high exports. And again, the resilience have been one of the key catalysts to that. And again, any weakness in the U.S. economy, any weakness broader to the global economies, I think will be the key risk of catalyst for the markets. Yeah.
I mean, I'd even add China in there. China has been a recipient of that tailwind from, U.S. demand for their exports as well. And the data we got out of China on the weekends, it seems that the economic situation seems to be decelerating even further. And not that global investors were overweight to begin with anyway, extremely underweight that market. But, a lot of people have told us China remains a tactical opportunity right now because of how cheap the market is. Do you think the data on the weekend, I guess in some way, challenges that notion that there is a tactical opportunity in this Chinese equity market?
I mean, I've seen reports, and I think, of course, look at valuations, and again, it's one of the pillars that we'll look at. Yes, it's tempting to say that, but we look at macro, it's not there. So the macro elements are very weak across the board. The consumption is very weak. We've heard about it. The investment is weak. What we've seen somewhat resilience into, I would say, this quarter has been the exports, as you said, have been more resilient. And we've seen some front loading from some of the importers, because considering that we're coming into election year and uncertainty around the outcome of that election. So that has kept China. But I think what would change the investor sentiment, and I would say sentiment towards taking opportunity of those valuations or cheap valuations is to see more forceful and decisive measures from the government to support the economy. And we've talked extensively about the need to be done more for consumption, the need more for services, and certainly some elements to support the property market. Again, it's a challenging framework that they're in, but certainly measures that are more forceful and directed at those two elements, I think, will be crucial for
what would be the bazooka, you think? Like, particularly on consumption and property, that would change your mind?
It's unlikely. We don't see a bazooka coming. I don't think they have room to do a bazooka. As we talked about monetary policy, I think the Fed gives them a little bit more room to move the monetary policy. But moving it further, they are conscious about net interest margins for the banks, which again puts pressure on financial stability potentially. When you look to fiscal, again, fiscal has more room, and they've lagged in terms of that fiscal support. There's more room to do in that fiscal space, but the question is where to deploy that money, and I think that's the bigger question without, again, bringing leverage into the wrong parts of the economy. So reallocation of resources into the right parts of the economy is crucially important. And I'd say doing more for the consumer, doing more potentially for that property with certain measures. And again, them being innovative, I think, from here to decide how they can do that, I think is quite important. There's various measures that have been speculated in the market of creating a fund that warehouses some of those properties that to support the market. So again, providing a downward spiral, stopping the downward spiral in the property market, and helping the consumer alongside that, I think is crucial from this point onwards. Yeah.
Thank you, Ecaterina Bigos, there, CIO for Asia ex-Japan, Core Investments at AXA Investment Managers. Let's take a look when it comes to the pre-market in Hong Kong. Of course, it's the only market across China that's open here today, and we are seeing declines across the board so far. HS Tech is down about 0.7%. Same when it goes to H shares here this morning. We got plenty more ahead. This is Bloomberg.
We're poised for a lower open when you look at these markets in Hong Kong. And as you can see, a lot of that had to do with, of course, the weak data that came through over the weekend. Separately, there's also this strong typhoon that's barreling into the Yangtze River Delta, the biggest typhoon to hit Shanghai since 1949. You're watching the China Show. The Open is next. This is Bloomberg.
Welcome back. You're watching the China Show. We're counting down to the open of just one market here in China, and that is Hong Kong here today. Of course, onshore markets are shut as we count down to the Mid-Autumn Festival. Also, there's a typhoon that we're bracing for in Shanghai right now. I think it's the worst in 75 years. So certainly you see it across our dash cam here this morning. But there you go. You're seeing where the Hang Seng is doing in the pre-market. We are seeing some sizable declines here right now on the back of this pretty disappointing day that we got over the weekend, Dave.
Yeah, a miss across all. And I think you have to back up till Friday. You had the credit numbers which came through fairly weak. Fittingly enough, you had the PBOC and also the Finance Ministry coming out and trying to sort of offset the bad news. And we'll dissect that in a moment. Certainly, we're waking up here in the Asia Pacific to Yvonne's point. You have a typhoon. You have an attempted assassination attempt. Donald Trump is safe. And, of course, we're looking at more growth forecasts for the Chinese economy being cut. You have Citi, Goldman Sachs, and Morgan Stanley, the latest on what we have seen so far, to take that cleaver to their projections in China. Mainland China's closed, just to mention that, too, among other markets. So we do have Hong Kong coming online right now, 0.5% to the downside here. We're specifically focused on a couple of things. Alibaba and e-commerce on the back of news going into the weekend here. Perhaps on the tightening of the screws as it pertains to some of the conversations around e-commerce in the U.S. So PDD share is going to be under pressure due to this U.S. crack. That's according to the sell side on Citi. Flip the boards, please. The big story, of course, this week, and I'll get to this in a moment here, is on HKX and the biggest listing since 2022. So could actually vault the exchange or Hong Kong here from from about 8th or 9th place in terms of fundraising, maybe into the top 5. We'll see how large, of course, that eventual listing is going to be here and whether they top that up with the over-allotment on Midea. A couple of other things still going into that as well. So you have, I think it was Shunfeng SF Holdings also being reviewed as far as that listing application is concerned. And of course, there's also another one which I forget, actually. We're looking at, I think my producer's about to help me out. That's about to come on your screens as well. Yes, there we go, Gore Tech. And that subsidiary that they're planning to list here in Hong Kong. Thank you so much for that. China Eastern, we're looking at some of these airlines on the back of this, all the travel that's taking place there. I think there's a couple of tens of millions. I think Xinhua came out with a specific number on how much travel we're going to see. BYD, the story here, we now have a date out of Europe, I think September 20 or 22, on that vote here on tariffs, 25th of September. And, of course, on the back of the data which came through on the weekend, weak property prices. In fact, we have a chart that shows you this as well. Flip the board, so have a look at it very, very quickly here. 0.73% month on month. That was the decline. 15 straight months. It's not this guy. Can we click on the other chart, please, if we can? 70 cities, the average, just to show that as well. 0.73% is what we're looking at there. Thank you so much. There we go. Steepest monthly drop going back about 10 years, 15 straight months of monthly contraction. And because of that, because of the data we talked about here, this is the growth forecast. Currently, we understand every single one below 5%. The latest to come out was, of course, out of Citi. You have Morgan Stanley and Goldman Sachs out with their new forecast here for the Chinese economy. Yvonne.
Yeah, I think Goldman, we were just talking to Hui Shan just last week when they still had that 4.9% forecast, and she did talk about maybe some of these downsized risks. I think this data kind of changed that in some ways, and really saying that 5% target is looking to be more out of reach now, and really a more urgency, they say, for more demand side sort of stimulus is now in the cards. Certainly that's going to be a lot of what could weigh on China. But again, they're shut, those markets, until Wednesday. So we might have to wait a few days for that reaction. But right now, let's talk a little bit more about the wealth side of things. And someone's in town, Andy Sieg, head of wealth at Citi. He joins us here in the Hong Kong studios. Andy, it's great to have you back here.
Hey, good morning.
In the region. You're here for a long trip in Asia as well. I'm just wondering, what's the message to your staff, to clients?
Well, this is the epicenter of global wealth creation, really Hong Kong, Singapore, across Asia. When we look over the next 10 years, there's going to be over $100 trillion of global wealth creation, and that fastest rate of growth is in Asia. Citi's been in Asia over 120 years. We are bullish on Hong Kong, and our roots are very deep in this market, so the perfect place to start the trip.
What's the overall strategy now in terms of covering not just Hong Kong, but as I guess a jumping off point to cover mainland China as a business, because it was very recently, of course, you guys unloaded that asset to HSBC. So what's the general plan on how to cover mainland China?
Well, our strategy in Asia is really centered in Hong Kong and Singapore. Okay. We're focused on our clients, of course, who look to us for cross-border advice and cross-border service. In wealth, we have a private bank organized globally, which is really there for a very special segment of clients. We like to think about them as the world's change makers. These are people who may live in Hong Kong, their families in the U.S., they're interested in investing in businesses in Europe, and they see Citi as uniquely positioned to give them the advice and be where they need to be.
Do you get a sense that it's getting harder for mainlanders to move wealth offshore? And how do you tap into that?
Well, I mean, I think in many ways it's almost the opposite. I mean, when I think about the Wealth Connect program, Citi's retail bank is thriving in Hong Kong, and our Citi Gold businesses, which serve the high net worth and mass market, are very much plugged into the Wealth Connect program. And so, you know, in my view, I think Hong Kong's role as a bridge between China and the broader global financial marketplace is very recognized and supported by public policy. We're here to serve clients as they take advantage of those linkages.
And what specific steps are you guys taking to regain market share then in your key markets here in the region?
Yeah, I mean, hey, first and foremost, we want to ensure that the business that we have here is energized and as productive as possible. That is going extremely well. Our investments business in Hong Kong specifically is up almost 20% year on year. You know, it's the right kind of business. Our clients are bringing more of their assets to us. This region of the world is leading Citi's businesses in terms of net new investment assets, which is where we really look to the long-term health and strength of our business. Now that productivity's up, you're going to see us also adding people.
You mentioned when you just sat down of the energy that you feel when you come to Hong Kong. You're saying you're still quite bullish of the prospects here in the city. I mean, if you look at these two wealth hubs like Hong Kong and Singapore, which one is the bigger one? What do you tap more of your attention to these days?
Well, I mean, I think you have to look at them both in terms of the unique role they play. I mean, Hong Kong is the #2 offshore wealth center in the world. And so we've got clients who are focused here. And despite the changes in the market, I mean, they continue to be focused in Hong Kong. We have other clients where they move their family office to Singapore. We provide a little bit of a different spectrum of services across our investment bank, corporate bank, commercial bank. Likewise, we're very focused in both markets, but, different areas of activity. What's happening in GBA, the wealth creation, the entrepreneurial dynamism, that's a place that Citi's commercial bank out of Hong Kong is incredibly well positioned to address.
Well, I mean, do you foresee at some point the need for you guys to reestablish your footprint onshore, or is the foreseeable future for the Greater China business and GBA solely out of Hong Kong?
I mean, hey, I think right now we're very comfortable with the footprint we have, where we're serving clients. And I say that not because our business is doing well. I say that because our clients feel, hey, we're where they want us. And obviously, if they want to see us, in Shenzhen, we're on a train and we're there in 20 minutes. So it's very easy to be based in Hong Kong and serve this region exceptionally well.
How are you looking at hiring here right now? I mean, obviously, we've been dealt with what Citi has been dealt with, these job cuts in Asia, wealth. Are you seeing that's going to be done?
Yeah, I mean, coming into the year, the real focus, specific to wealth, but more broadly at Citi was, hey, we need to get fit. We need to be more nimble, and the organization needs to be flatter. This has been Jane Fraser's strategy. We've executed it with great focus this year, and we feel we've made progress. We're where we want to be in terms of the size, the structure of our organization. From now, what you're going to see is us looking to add talent on a selective basis behind that productivity that I talked about earlier. When we see the average banker in this region bringing in the kind of new client volume that they are, that gives us confidence we can add additional individuals in the market, and it will pay off for shareholders and extend our reach.
Are you looking at specific markets where you might be looking to add that manpower complement?
Well, you would see them based here in Hong Kong, but serving the region more broadly.
Do you have a number in mind? How much are you looking to hire?
No number today, but you're going to see it over the quarters to come.
Are there geographies that you look at in particular here where you would be focusing your most?
Well, I mean, hey, our clientele, when we think about the private bank, anywhere wealth creation is happening, Citi is there. And so it's clients in the mainland, some of those entrepreneurs in GBA. We've got a thriving business in Taiwan. We've got some phenomenal clients in the Philippines. We serve all of those from Hong Kong. This is our home. As I said, this is where our roots have been planted for 122 years. And then with the retail bank here, that makes us very relevant to mass affluent and high net worth clients, who are building businesses and really driving the local economy.
Family offices, which is an old concept. It's a new old concept in Hong Kong. There's been a lot of rethinking what that actually means here. Singapore and Hong Kong. How are you guys approaching that?
Well, we serve 1,800 family offices around the world, so this is a giant part of our business. We're very bullish on family offices. When I travel around and meet with companies, one of the things I'm very taken by is how frequently family offices now come up as a preferred source of capital. In many ways, people have obviously raised a lot of investor interest from private equity funds over the last 10 or 20 years. When they look at family offices today, they see a level of sophistication which is very high, but they also see an extended time horizon. They don't feel like a family is necessarily going to be focused on a 6 or 7 year exit. So for some companies in some circumstances, family offices are a very attractive partner to build their business.
You mentioned about the reorg, and one of the things about maybe the outcome from that was that you had to shut a lot of your consumer businesses. That proved to be a pretty big pipeline for the wealth side of things. Are you concerned that you don't have that pipeline anymore?
I'm not concerned, because I think what we gave up in terms of some of the reach in the region, we have more than made up for by bringing focus to our business. So now we have retail banking here and in Singapore and also in UAE. Those retail banks, they're much more focused, they're much more tied to wealth, and they're driving some of that net new investment asset, that productivity that I talked about earlier. So while the business is a bit narrower, it's a much deeper, thriving business today.
And I'm just looking at the numbers, nuancing that, of course, with the fact that you guys had to sort of unload some of the retail business. I think you guys, as a wealth business, 7.1 billion, if my memory serves me correct, 2022, 7 billion for the full year 2023. I think you guys have done 3.5 billion revenue first 2 quarters of this year. Do you think you get a 7 billion this year?
Well, I'm not going to make forward-looking comments about results, but what I would say, you think about the size of some of those businesses in wealth terms, multi-billion-dollar wealth businesses. They got headlines. Just in the second quarter, this wealth business brought in over 9 billion of net new investment assets. So I want to put some of those numbers in context. This is an incredibly productive business in terms of the kind of incremental growth that we're generating. And as I said, we've traded off some reach for focus. Clients are giving us feedback that that's been positive, and we're seeing it in the numbers.
Right. Well, I guess what I'm trying to get to is you mentioned that in terms of scale, it's perhaps smaller, but the focus is a lot more concentrated. I'm trying to get a sense of whether or not that scale is going to show up in your numbers as well. Is it a smaller business? Is it a smaller franchise?
Well, I mean, and again, we're in the middle of the quarter, but if I look at the second quarter, you saw it in the numbers. Revenue were up. Revenue was up, expenses were down, so we had operating leverage in wealth for the first time in 3 or 4 years, and we feel we can keep that trajectory proceeding.
Andy, it's great to see you. Thank you so much for taking the time. Straight off the plane, I believe?
Yes.
Straight off the plane, you
Almost.
bet.
There we go.
I was excited to be here.
First stop,
right here,
Monday morning. We'll have a great rest of your trip ahead. Andy Sieg there, of course, out of Citi, joining us here on set. Right, going into 13 minutes into the session right now, cash market session. A kind reminder, a lot of markets across the Asia-Pacific are shut, including mainland China, 1.4% on the HS Tech Index. Plenty more ahead here. You're watching The China Show. Good Monday morning. All right. The big story, of course, we're tracking as well here in Hong Kong. Biggest listing in about 2 years or so is the Midea Group. That's an appliance giant set to debut on the Hong Kong Stock Exchange on Tuesday, raising $4 billion. Let's bring in our Asia Equity Capital Markets reporter, Julia Fioretti. She's here with us to talk us through this and what this deal tells us about the state of this recovery in fundraising here in the city.
Hi there. Well, I wouldn't yet call it an opening of the floodgates. We have to see how it trades, obviously, and there are a few caveats about this deal, such that it's already listed in China, and so it's not a company that investors don't know and haven't been following for years already. But certainly there are good signs that that we've had global investors who are now playing Hong Kong deals again for the first time in years, potentially, at least in this kind of size. It was multiple times oversubscribed. Its books closed a day early. All that priced at the top, obviously. So all that points to strong demand for this deal and sort of a renewed appetite for Hong Kong IPOs.
Yeah, what can we expect for this trading then tomorrow?
The signs are that it should trade well. Don't want to sort of call it wrong, but the signs are that it should trade well because it priced at the top, was well oversubscribed, and it had marquee investors coming into the book. Obviously, people will want to watch how it trades on the first day and also after the first week, just to see whether this can be a read across to other deals that will be following.
Do we know if they exercised the over-allotment?
We don't know that yet.
Okay.
That will only come after trading. But they did exercise the upsize option. So they already upsized it by 15%.
Okay.
So that's also a sign that it would probably a strong book.
Okay, well, fingers crossed.
Yeah. Julia Ferretti, thank you, our Asia Equity Capital Markets reporter, joining us there ahead of that debut tomorrow. To some other corporate stories that were falling out of China today, PwC China has fired 6 partners. It blamed for shoddy audits of the fallen property developer Evergrande. Now, the firm also fired another 5 staff members who worked on the developer's audit. PwC's move comes after Chinese authorities said the firm failed to identify financial fraud at Evergrande and concealed accounting misstatements. The EU is said to be planning to hold a vote on raising tariffs on Chinese EVs on the 25th of September. The vote would pave the way for the duties to kick in from November. The EU are proposing to hit SAIC, Geely, and BYD with charges in addition to the 10% tariff that exporters from China are already subject to. Meanwhile, China's auto trade body has helped car makers submit a new price commitment plan to the EU. We got plenty more ahead. This is Bloomberg. Well, Hong Kong's property market has slumped on falling prices and rents, and due to higher interest rates coupled with the economic slowdown in China. And a flashy new skyscraper in Hong Kong called the Henderson, which is just across the street from where we are right now, is actually struggling to fill its office spaces and highlighting the pain. Bloomberg's Min Lo has more.
It's the newest addition to Hong Kong's iconic skyline. And its flagship tenant, Christie's, will soon open its doors to the auction house's new APAC headquarters, taking up 4 floors of the Henderson building, which soft launched in June. But as of May, this brand new office tower was still 40% vacant. Henderson Land declined to provide the latest occupancy rate. It's a situation that reflects the deep slump in Hong Kong's commercial real estate sector.
Vacancy, unfortunately, continues to go up. This is a big hurdle, the biggest hurdle for major landlords in the market. We are currently talking about 17% vacancy rate, and this is a new record high for Hong Kong. We have about 15 million square feet of vacant space in the market. This is a massive number.
That's about 260 football fields that analysts say will take 6 to 7 years to be absorbed. As office vacancy hits record high, sources are saying Hong Kong's landlords are resorting to paying agents fat commissions worth 2 to 3 months' rent to fill up spaces, up from just 1 month several years ago.
Walk around Causeway Bay and you get a sense of the commercial property downtown here in Hong Kong. This was once the world's most expensive shopping district. But if you take a look at Hysan Place, the luxury shopping and office centre owned by Causeway Bay's largest landlord, Hysan Development, and you find that the shops are still there, but not necessarily the crowds.
Weak demand has driven down rental values by as much as a third from the peak of 2019. But a spate of new office developments slated to enter the market will exacerbate the supply-demand mismatch. This a result of the long time lag between investments made during the bull run of 2017 and 2018 and the multi-year construction cycle that would see these projects come into fruition when market conditions have already worsened.
Between now and the end of 2028, for example, these 5 years, we expect to see another 8.5 million square feet of new space that would come into the supply pipelines. Put it short, I don't see a very good chance that the market will back to normal before the end of this decade.
The Hong Kong government has paused commercial land sales for 4 straight quarters, hoping that would help clear existing inventory before new supply is introduced. While that's helpful for the sector, CBRE expects rental values to continue falling by 5 to 6% this year. Meanwhile, a pause in land sales is already crimping on one of the most important sources of government revenue that has helped enable Hong Kong's low-tax system that is crucial to its business hub status. Min Lo, Bloomberg News.
There you go.
Okay, yeah, we'll have more coming up here on the China Show, a deep dive into the ailing property sector with a focus here on what's happening commercially with offices. And the head of Valuation and Advisory Services at CBRE joins us to give us her thoughts, of course, later in about 20 minutes from now. So stay tuned for that interview coming up. Right, coming up here as well, having a look at markets. So mainland China is shut, among other markets shut today in the region for the Mid-Autumn Festival. We're looking at Hong Kong. Well, on the back of that, we're now looking at, this is according to the Ming Pao news here, that hotel bookings in Macau are actually full. But this is for Golden Week from October 1 to 7, looking forward there. Certainly there are some signs of crowds starting to pile up here in Hong Kong, certainly without going into too much detail. Where I live, there's a ton of, let's just say, Xiao Hongshu enthusiasts taking their share of pictures. And
with you?
No, not me. No, clearly not. No, they'd be wasting their time and cloud space at that. Airlines too. We're focusing on that too. Yeah.
Yes. Well, you take a look at when it comes to what's been going on in Shanghai, right? So heavy downpour when it comes there, and the biggest typhoon in more than 7 decades hitting the financial capital. So we've already heard of some cancellations as well Take a look at how these airlines are reacting to it, and it's not good. Places like Air China, that's down some 4% here. So they are bracing for Typhoon Bibingka. This is one, or Beibija in China is how they call it. But it did cross the coast of the Yangtze River Delta region at around 7:30 this morning as well. So that's according to what we've been hearing from CCTV.
Okay, the benchmark situation here in Hong Kong is we're looking at declines, and of course within this, we haven't talked about this too, is some of the concerns around e-commerce with Alibaba, as you can see, down about 1%. So Alibaba's bottom row, third from left, on the back of this potential, do we call this a crackdown? PDD and some of the e-commerce plays in the U.S. We'll talk more about that later. We're down about 0.8% on the Hang Seng Index, ahead, of course, of key central bank decisions this week, including the Fed. And, of course, because there's the Fed, there's also likely a rate cuts out of the HKMA. Anyway, plenty more ahead. This is the China Show.
Welcome back to the China Show. Here's a look at the HSI just a half hour into the session. It's clear skies in Hong Kong, but Shanghai is a lot more wet over there as we wait for that typhoon. But certainly, we're taking a look at how assets are doing. And right now, you are seeing Hong Kong slightly on the back foot, though, although we have pared back some of the initial losses. But yes, if this is probably the market where you could feel where people are really expressing that concern with the data that we got over the weekend, Dave.
Yeah, everything from credit numbers to the activity data. And you couple that with the inflation print. So we now have the full set of numbers to get a sense of really I think the lack of progress, it might be a good way to put it, so far in the recovery there, which is why I think we're seeing, well, the lack of risk appetite on top, of course, of the Fed conversation that, who knows really what the Fed can and should do. The pricing on Friday was 50-50 for a 50. It's now slightly more for 50, so there are some bets coming in that we might get a slightly bigger cut coming out of the Fed. What is that vote going to look like? Will there be a dissenting vote coming through? So you do understand why there's a lack of risk appetite, on top, of course, of all the closed markets that we have in the region this Monday. In fact, just for a list of those closed markets, have a look at mainland China, South Korea, among the many other markets that are not trading today. I think we have that list coming up on your screens very shortly. Thank you so much. And there we go. So the market action today, not really a decent representation of how the markets would act. But then again, of course, given all the risk out there, probably is as well.
Yep, and we talk about, this week is going to be busy when it comes to central banks. The Fed certainly is going to take most of the limelight, but certainly we're watching what goes on with the BOJ to wrap up the week. So it could be a 36-hour sort of bonanza here of central bank policy making. And certainly, if the Fed's going to cut 25, 50, that's still a key thing. And whether Japan is going to indicate they might want to hike further as well. What does that mean for that unwind of that yen carry trade? That certainly is going to be the key focus. But yes, plenty of other central bank decisions coming up later on as well. We've got an LPR out of China to wrap up the week as well. Yeah,
let's get a sense of the rate conversation this week. And Garfield Reynolds, who leads, of course, our MLive team for the Asia Pacific, is with us right now out of Sydney. I mean, Garfield, just where is your head exactly right now on what the Fed will probably do, and what do you think they should be doing? Two separate questions.
Well, we're in a little bit of a silly season because we headed into the Fed quiet period with some chatter that sounded as though they were going to consider 50 but go 25 basis points. Since then, the inflation data would have seemed to push them towards doing just 25. But once that data was in, there was a bunch of speculation, some comments from former Fed officials, which emphasized that 50 basis points was going to be on the table, and in fact that there were some good reasons, as they put it, for going 50 basis points. So since that has happened in the vacuum that exists with no actual Fed comments, and in particular the sort of market recollecting that what really matters in many ways is the weak labor market, and the latest readings we got on the labor market were weak, the bets have, they sort of possibly have overshot by now. They went from being, no, there's no chance of 50 basis points to now it's about 50-50. Now it's trending towards 60-40. So that's going to make for potentially a very volatile meeting. And in particular, what a lot of traders are going to be concentrating on is not just how much the Fed goes, but how worried they sound about the economy either way. You know, if they can cut 25 basis points and persuade the market that they're doing that because they think the economy is still in reasonable shape and they're willing to go 50 if they need to, that might actually prove to be better for equities in particular than if they cut 50 basis points. If they cut 50, then they face the need to persuade investors that this is not a panic move, that they're not behind the curve, that this doesn't mean the economy is in recession. It just means they're making sure it won't enter recession.
And Garfield, we did hear from Ecaterina Bigos from AXA Investment. She just talked about, you know, when you look at the case around a 50 basis point cut, it's not quite there if you take a look at the numbers. Let's just take a listen first.
The reason that we're seeing such a division is that the 50 is not in the data at the moment. If you look at all the data that's coming through, we have the estimate of GDP Atlanta now, which is at 2.5 GDP estimates, which is very healthy. But we've had a call ISM data. And also, if you look at the labor market, you know, we still have the wages that are healthy or resilient. And also there is a healthy job creation. So we haven't seen a negative print yet in payroll. So I think broadly, I think 50 is not in the data.
50 is not in the data. I take a look at how Treasury yields are doing. We've been basically falling for 2 straight weeks. That 2-year yield is at, I think, the lowest we've seen in 2 years as well. Is there now quite a bit of room now for this bond market to actually reverse?
Well, there's some room for that, Yvonne, especially if the Fed sounds very confident about economic resilience. You know, probably the biggest takeaway I had from the action that went on last week, when looking at what was going on with bets on Fed moves, was that 25-50 at this meeting was sort of 50-50, but we're now looking at something like at least 9 25 basis point cuts priced in over the coming year. That's the strongest bets we've seen on easing at the start of a Fed rate cut cycle. So for bond traders, to some extent, I don't think they'll be too perturbed if there's only 25 basis points, provided from their point of view, the base case remains that the Fed is going to cut and cut and cut, and then that there's going to be at least one 50 basis point cut in the coming year, even if they don't get one to start the cycle. So that's going to be the question for the bond market. And sort of the inverse for the equities market. By now, the equities market is probably going to be a bit worried if the Fed ends up endorsing that level of rate cuts that the bond market is pricing in, because that would certainly put you at least on the verge of the Fed assuming that a recession is coming. Otherwise, why would they endorse that many rate cuts?
Garfield, thank you. Garfield Reynolds there, who leads our Bloomberg MLive team in Asia, joining us from Sydney this morning. On the back of that, we're also taking a look at the weak data that we got out of China over the weekend, and it's really prompted the likes of these major banks. Goldman Sachs, Morgan Stanley, and Citi have now lowered their 2024 China GDP forecast. SocGen as well recently downgraded their forecast to 4.8% as well. As bringing Wei Yao. She's the head of research and chief economist for APAC at SocGen. You took a look at the numbers this weekend. Is there a sense that this recovery is basically losing steam in a big way now?
Yeah, indeed. I think the data basically confirm what we saw in the previous few months, is that the growth is losing momentum. The exports are okay, but it's apparent that the economy as big as China cannot just rely on external demand.
Is there well, there's certainly a camp that thinks there's a reluctance to add more stimulus to this market. Do you think that's accurate?
Yes, I think that's very much the case. I think the contrast cannot be starker, when we talk about Fed 25 or 50. with very decent growth in the U.S., then you look at China, things are sort of slipping to a downward spiral, but the government is so reluctant to do anything meaningful.
Why do you think there is that hesitation for more stimulus?
I think it's the same as we discussed before, at the very top. The strategy, the big long-term strategy is about supply, is about manufacturing sector. It's not about domestic demand. So, yeah.
Is there I think for one, do you think the Chinese economy is sleepwalking into a deflationary spiral? And do supply-side reforms, even if they take longer, do you think that they manage to help avert China going into that as well? I mean, is that just another way of attaining the objective?
It's just not possible because you need demand, right? I mean, China cannot expect everyone else to absorb its demand. You look at China's manufacturing surplus is now running at $2 trillion. Who has that kind of appetite? Everyone's sort of pushing back on China's surplus. So the big economic imbalance is not just a problem for China, it's actually a problem for the whole world.
And how do you see, everyone's thinking that we might see some fiscal policies, whether it's special bond issuance, whether it's something that goes directly to consumers. I mean, what do you think would be actually enough to shore up consumer sentiment?
Well, I think, yes, indeed, the first thing is still housing. You need to stabilize housing. Right? So if the housing prices continue to fall, you have the very negative wealth shock to the confidence. On that, the housing destocking program is a step in the right direction, but the implementation has been so slow for various reasons. Then it's a question of, the central government need to step up the borrowing and to spend to counter the deleveraging force at the local level.
The move to reduce the burden on mortgages, because that in some ways that's almost a somewhat transfer in wealth back to consumers. Do you think they'll spend it? And what are your projections on how large that transfer is?
That would be helpful, certainly.
Okay.
The households, I think, even if they don't want to spend the money that's saved from that move, they will feel better, for sure. If you look at 80 basis point, it's not a huge boost at the macro level. It's barely 0.1, 0.2%. And assuming as a percent of GDP, assuming they spend some of it. But the point here is, the economy needs help, any help on the demand side.
Are you more worried now that China will stay in this sort of deflationary loop, as you say? I mean, are we seeing a sense that deflation is still quite entrenched in the economy now?
Yeah, the risk is definitely creeping up, day by day because of the inaction from the government. You look at the data, this is not sustainable. This is going to cause bigger problem down the road.
Well, okay, let me quote the finance ministry officials say that they will implement, and I think we've heard this before, they will implement proactive fiscal policy to help the economy achieve its annual target. So let's say the gap is 0.3%. From the consensus of the market, which is 4.7, 4.8. Can they cover that easily in 3 months' time?
Normally they can. It's not too late for them to hit 5%. But at the end of the day, I think we're sort of in this cycle several times now, which is they push a bit harder at the end of the year. Things get a little bit better in Q4, Q1. Then they stop trying again. So what we need is a strategic course correction, paying more attention to the demand. This is what we need for China.
Do you see any sort of bright spots then? I'm wondering, do you see anything that is giving you a little bit of hope?
I think the hope partly lies in the fact that the housing has corrected so much. Of course, you can certainly say it can correct even more, but things really correct a lot. If you look at the starts, investment, housing demand, maybe not yet prices. You do have, essentially the households, they have saved a lot. If you can revive their confidence somehow, things can turn. Yeah, but we need something first to help that turn around.
What is central to that solution? Is it fixing the housing market? Is that almost a necessary minimum to improve household confidence?
Stabilizing the housing prices.
And how long will that take?
At this rate, not very soon. They really have to try harder. I think the other news about new funding source for the housing destocking program from local government bonds, That would be helpful if they implement.
The renminbi's been strong. I mean, I'm just wondering, a lot of it has to do with the dollar moves, but everyone's kind of talking about if the Fed starts to cut, we have narrowing differentials in yields, and that could send a lot of Chinese exporters with dollar assets back to China. I mean, this repatriation flow, so to speak. Do you think we're going to see a big flood of that come back?
It's possible, but we are very skeptical about the amount, right? Because the simple fact here is you don't have many decent investment options in China, even though the yield spread will narrow, but it's still better outside than inside. And the other thing is, taking money back to China is like Hotel California, right? Come in, you can't get out. So why would you want to do that? It's very little incentive to see big flow there.
Okay, well, I can't say I feel much better after that conversation. Wei Yao, thank you so much. Happy Monday to you, too. Head of research there, chief economist for the Asia Pacific at SocGen there. Right, just ahead here in shows, former U.S. President Donald Trump is, well, he's safe after a second apparent assassination attempt. The details of what took place just hours back. This is Bloomberg.
Former President Donald Trump is safe and unharmed following a protective incident shortly before 2 p.m. on Sunday at Trump International Golf Club at West Palm Beach. The U.S. Secret Service personnel opened fire on a gunman located near the property line, and this matter is under investigation.
And that was the U.S. Secret Service speaking after the apparent second assassination attempt against former President Donald Trump. Bill Ferries, our Asia senior editor, is in Singapore for us to get us up to speed on where we are here. Bill, I mean, you can't make these things up. And certainly the big news when we woke up this morning was this. Do we know more about the perpetrator here? What do we know about motivation?
We don't have a lot of details, but what police officials have said is a 58-year-old man who seems to have had a long and difficult relationship with law enforcement over the years, going back 20 years. He's been charged and convicted on a number of different kinds of crimes, including, according to NBC, possession of a machine gun. He seems to have been involved in hit-and-run accidents. More recently, he's been very engaged in trying to recruit people to go to Europe to be involved and help out with the Ukraine-Russia conflict. So someone who is known to law enforcement, and we're expecting to get some more details in the coming hours, but don't have a lot of information right now on what his specific motivation is. People are scouring his social media accounts and looking into his past, but we just don't have that information yet. This is all obviously less than a day old at this point.
And I remember back during the first attempted assassination in Pennsylvania, there was a lot of scrutiny around security, even around presidential candidates, not just the president right now. Is this a case where maybe we did see the Secret Service and the security side of things did things right in some ways, or is there still more questions about that?
I think there's going to be a lot of questions still. I mean, this was someone who was apparently hiding in the bushes, just inside or just outside the fence at Trump's Mar-a-Lago golf course. The Secret Service was out ahead of Trump. They were at least one golf hole ahead of him and spotted a rifle poking through the fence and exchanged or fired at the person there, who then fled up the main highway up the Florida coast. So the Secret Service seems to have gotten ahead of things. They said that former President Trump was anywhere from 300 to 500 yards away. It would have been a very long shot. But again, yeah, it's going to raise a lot of questions about security at the golf course. It could potentially put candidates from both parties in more of a security bubble going into the last 7 weeks of this campaign. And of course, we're going to have to wait and see in the days ahead whether this has any kind of a political impact on the race itself, whether it swings people in either direction. After the first assassination attempt, you did see a small rally in former President Trump's favor that quickly dissipated in the weeks ahead.
Bill, thank you so much. Bill Ferry, there in Singapore for us, our Asia senior editor. In fact, just in the last note that Bill was just mentioning there, I think we have a chart which I believe our producers can bring up right now that show that pickup actually in support for Donald Trump following the first assassination attempt. We've yet to see, and betting odds in Trump are in blue, we've yet to, in red rather, we've actually yet to see that take place following the second attempted assassination.
Yeah, markets are still pretty steady as well. I take a look at U.S. futures. I take a look at dollar. There was a bit of a dip in Bitcoin. Not sure if that was related, though, as well. Let's get to some other big geopolitical stories that were falling for you today. Jordan's King Abdullah appointed Jafar Hassan as the new prime minister after the resignation of Bashir al-Khashoggi. Now, this comes days after parliamentary elections in which the opposition Muslim Brotherhood made big gains in the back of anger over Israel's war in Gaza. The new government will need to accelerate IMF-guided reforms and rein in more than $50 billion in public debt. Israel's inflation also ramped up more than expected in August as the war in Gaza strains the economy and pushes government spending higher. Prices rose 3.6% year-on-year last month, now well ahead of the country's official target. Analysts surveyed by Bloomberg had forecast the rate to hold steady. The Philippines has withdrawn its vessel from a South China Sea shoal that recently has been at the center of tensions with Beijing. The Coast Guard says a ship was compelled to return to port from Sabina Shoal due to bad weather, depleted supplies, and the need to evacuate personnel requiring medical care. We got plenty more ahead. This is Bloomberg.
Welcome back. You're watching The China Show. Here are some of the big corporate stories we're following out of China today. PwC China has fired 6 partners it blamed for shoddy audits of fallen property developer Evergrande, and the firm also fired another 5 staff members who worked on that specific audit. PwC's move comes after Chinese authorities said the firm failed to identify financial fraud at Evergrande and concealed accounting misstatements. Now, the EU is said to be planning to hold a vote on raising tariffs on Chinese EVs on September 25. Mark your calendars now. Now, the vote would pave the way for the additional taxes or tariffs, of course, to kick in from November. Now, the EU are proposing to hit SAIC, Geely, and BYD with charges in addition to the 10% tariff that exporters from China are already subject to. Meanwhile, of course, China's auto trade body has helped car makers submit a new price commitment plan to the EU. Brief look at markets and some pockets of this equity market we're tracking here. E-commerce stocks in focus today after this U.S. trade crackdown. And as you can see, shares of the likes of Alibaba and JD.com are down this Monday. Certainly the story here is you have, well, the U.S., PDD, of course, on Friday did fall after the White House cracked down on some of the shipments. It's a fairly more complex topic to tell you about within a few seconds or so. But, yeah, that's the story there for now. We'll unpack that a bit later on. The other drag across these markets, too, is on the back of property numbers. New home prices fell in virtually every single city, up to 70 cities surveyed, month and month. And we're looking at fairly hefty declines here across some of these property counters that are open. Mainland China, of course, is shut today because of a holiday. There is separately also the other big story on the mainland today, and have a look at airlines and where we are there. A typhoon that has barreled through, of course, and has made landfall a couple of hours back. CCTV reporting that it is the strongest typhoon to hit Shanghai since 1949, resulting in torrential rains in many parts around that part of the country, central and southern Jiangsu, Shanghai, Zhejiang, and other places, of course, on Monday. Right, plenty more ahead. This is Bloomberg.
Welcome back. You're watching the China Show, a live look out of Hong Kong here this morning. And of course, we take a look at what's been going on, that beautiful skyline. There certainly is a lot that is hanging over this, especially the commercial property market in some ways, right? If you take a look at what's going on in the Hong Kong side, there is this new skyscraper not too far from where we are. It's called the Henderson. It is struggling to fill its office spaces. The one next door, certainly I feel like is going through the same sort of issues as well, really highlighting the sort of pain that we're seeing in the real estate market here right now. Our China correspondent, Min Lo, has more.
It's the newest addition to Hong Kong's iconic skyline. And its flagship tenant, Christie's, will soon open its doors to the auction house's new APAC headquarters, taking up 4 floors of the Henderson building, which soft-launched in June. But as of May, this brand-new office tower was still 40% vacant. Henderson Land declined to provide the latest occupancy rate. It's a situation that reflects the deep slump in Hong Kong's commercial real estate sector.
Vacancy, unfortunately, continues to go up. This is a big hurdle, the biggest hurdle for major landlords in the market. We are currently talking about 17% vacancy rate, and this is a new record high for Hong Kong. We have about 15 million square feet of vacant space in the market. This is a massive number.
That's about 260 football fields that analysts say will take 6 to 7 years to be absorbed. As office vacancy hits record high, sources are saying Hong Kong's landlords are resorting to paying agents fat commissions worth 2 to 3 months' rent to fill up spaces, up from just 1 month several years ago.
Walk around Causeway Bay and you get a sense of the commercial property downturn here in Hong Kong. This was once the world's most expensive shopping district. But if you take a look at Hysan Place, the luxury shopping and office centre owned by Causeway Bay's largest landlord, Hysan Development, and you find that the shops are still there, but not necessarily the crowds.
Weak demand has driven down rental values by as much as a third from the peak of 2019. But a spate of new office developments slated to enter the market will exacerbate the supply-demand mismatch. This a result of the long time lag between investments made during the bull run of 2017 and 2018 and the multi-year construction cycle that would see these projects come into fruition when market conditions have already worsened.
Between now and the end of 2028, for example, these 5 years, we expect to see another 8.5 million square feet of new space that would come into the supply pipelines. Put it short, I don't see a very good chance that the market will back to normal before the end of this decade.
The Hong Kong government has paused commercial land sales for 4 straight quarters, hoping that would help clear existing inventory before new supply is introduced. While that's helpful for the sector, CBRE expects rental values to continue falling by 5 to 6% this year. Meanwhile, a pause in land sales is already crimping on one of the most important sources of government revenue that has helped enable Hong Kong's low-tax system that is crucial to its business hub status. Min Lo, Bloomberg News.
Well, let's dive deep into Hong Kong's property market now, bring in our Bloomberg News Asia real estate reporter, Crystal Shah. She's here with us. Also want to bring in Hannah Jeong of CBRE, the world's largest commercial real estate services and investment company. Crystal, I'll start with you. We talked about the Henderson has opened this month. What do you think sentiment has been like?
So definitely we are seeing sentiment actually not improving. Hong Kong has been in a prolonged property downturn, and with 2 new very iconic skyscrapers coming up in Central, one being the Henderson, like you said, and the other being Cheung Kong Centre 2. Investors and also the market is really keenly watching the leasing rates of these 2 towers as a proxy of how the property market is going forward. And as we have seen just now in the TV package, Henderson is 60% leased. So, of course, the number could be higher, but we know that they have anchor tenants such as Christie's that's really bringing more value add to the building as well.
Hannah, I'll bring you in here. What's your current assessments of the sector right now?
The office market now, the vacancy is 17%, which is the highest in the history. But when we look at the fundamentals, like we do have a good economic growth, we are looking at 3%, and unemployment rate is also very stable at 3%. So the fundamental-wise is picking up. But again, the uncertainties from the economy make companies to reserve their cash and not really expand their footprint. So that has been the sort of challenges in the market. But if we look at Central, the vacancy rate is 14%, which is the highest in 2 decades. But companies are expanding in terms of the number of companies are expanding because government tried to bring more companies, not only from mainland China, but also globally. So we are betting on those kind of newcomers, how much they can take the space going forward.
Yeah, I was going to get you to, you mentioned about, I think it's 2 decades. I mean, the down cycles we saw back in 97, during the Asian financial crisis, 2003, does it feel like that? And can the government do anything to kind of avoid those cycles?
I think the pandemic was hitting us very hardly because we are one of the city open up the gate latest, right? So that's not avoidable, and that's not something government can do about it. But I think we have to bet on the positive fundamental. And if we look at the leasing activities, 40% of new leasing activities happen within the building built 2021 onwards. So many companies are looking for better quality building, better efficiency, higher ESG requirement. So we do see companies moving around, and that's giving activities in the market, and that's on the positive note, yeah.
Are those the bright spots you're seeing? Crystal, what bright spots are you seeing?
Yeah, so like Hannah said, I think there's a flight to quality. A lot of the tenants, they are taking advantage of lower rents, lower prices to upgrade to bigger and better spaces. So, of course, that would also force landlords to upgrade their buildings. And outside of the office market, there are quite a number of bright spots. I think one of which is student housing. We have seen a lot of new students coming in, especially from the mainland, with all the different talent schemes available out there now. And the universities, they do not have enough space at all for all these new students. So that means that these students would either have to rent in the private market or they would have to look for student accommodation. So we do see some landlords and some of the bigger developers also going into student housing.
The Fed could start cutting rates as early as this week. How does that help the property market here, if any?
It's very rare that Fed really adjusts the rate before the election. In history, 3 months prior to election, Fed won't really touch the rate previously. So it's quite surprising, and that's showing their eagerness to embrace the slow economic growth. For impact to Hong Kong, really, we don't see significant changes at this moment. There are 2 reasons. Even the HIBOR rate now is a sub 4%, which is the lowest at this moment, which is a very good movement. But if we look at pre-COVID, we were 0%, the HIBOR rate. So if we look at any other peer cities, 4% adjustment upward is the highest rate between other peer cities. So that gives a lot of pressure, even if it's lower down at this moment. And secondly, the yield generated from the property is still hovering 3 to 3.5%. If you borrow money based on HIBOR 4%, you still need to pay 5 to 7% to the bank, depends on what property you have. And that the spread, the negative spread, is quite significant, and that gives a lot of challenges to investors. So if they invest, they pay interest rate of 7%, but the yield from the property is only 3.5%. So that gives negative carries, and it has been the sentiment over the last 2 years. So investors are reserving their cash instead of putting on the any investment betting right now. So if we look at the figure, investment volume dropped by 52.3% quarter on quarter, and in terms of a number, 48 transactions happened the first half of this year, which is the lowest from 2008. So you can see how weakened the investment sentiment is. So Fed rate 25% basis point may not give too much lift in the market. But end of the year, if we really go down to 100 basis point, I think that will be the different story and give a really good indication to make waiting investor to make a good decision at this moment.
And just in terms of your outlook, and I think just in the TV package we just showed there, one of the views is we don't see the industry normalize for at least this decade. I'm not sure what metric they were using there, whether that's on an average rate, for example, where do you see leases going, commercial rates?
Commercial, in terms of the sentiment, we have to look at supply and demand side. So supply, we do have a very clear picture of the next 10 years. So on average, every year, 1.6 million square foot net take-up. So if we calculate the upcoming supply and the existing supply and those net take-up, actually the current vacancy rate of 17% may not adjust downwards too much up to the decade. So that's the math where we are coming from. But we still have a bet on how much economic will growth and also what kind of company or how many companies coming to Hong Kong that may switch some of the vacancy spots, and that will help the market. But at this moment, based on pure supply angle, yes, it will take about a decade to stabilize the current vacancy rate.
A whole decade. I mean, is that what you're hearing from a lot of the people you talk to, Crystal, now?
Yeah, definitely. As we have discussed, there's a lot of wait and see sentiment. The Fed is expected to cut rates going forward, but even then, we are not sure if the banks in Hong Kong will follow. And high borrowing costs is just one of many reasons why Hong Kong is in a property downturn. Other reasons are maybe poor business sentiments, geopolitical uncertainty, and of course the poor economic backdrop in mainland China is also hitting Hong Kong's property market. And these are factors that we don't really know how it will unfold over the next decade.
Hannah, what are some of the more structural factors that don't seem to be as obvious to many people that you think we should be paying attention to here?
I think the obvious factor is obviously the interest rate, election coming up, but I think more structural side is whether we are able to increase the population further. So we lost around 30% of population during the COVID due to the very stringent policy happened during the closed gate. Now, some population filled up by new top talent scheme and also mainland Chinese incomers, but still job market, whether they're able to create further for upcoming population. So I think the investors or landlord need to really look at the population growth. We do also competing with the North Metropolis, which government is putting a lot of effort to bring more manpowers and more companies, but maybe they will concentrate at the north. So what about Central and Causeway Bay or traditional business centers? So I think the key is really how many new population we can bring back to Hong Kong.
Have you seen any signs of the mainland, the government, central government, they're putting their support into Hong Kong's property market? Have we seen any signs of that right now?
I think at this moment it's more like playing on demand side, so helping more companies to setting up in Hong Kong, we also talk about retail sector, like we have individual visitor scheme that increase to 10 more cities, which have around 56 million population. So these people can freely come to Hong Kong for tour purpose. And then business traveling from mainland China also increased from 1 week to 2 weeks. So that's more helping on the demand side. And I think that has been the main focus from the central government as well.
Longer term, and since we're talking about the mainland, we're already starting to feel it, from an F&B perspective, for example, the integration with Shenzhen, which is easier access. At what point do you think we should be looking at commercial property? You mentioned Central and Causeway Bay. At some point, do we mention Futian, for example, as part of the available supply of grade A office space within the GBA area?
Possible. We have to really increase the boundary of the people movement. Now, many people going during the weekend, they spend their days in Shenzhen or nearby Hong Kong at the North Territory. But whether this will continue, I think it's quite a norm. But what we have to aware is if you want to buy something immediately, or if you have a plan to buy some laptops, etc., you will buy in Hong Kong. So that population who live in Hong Kong Island and Kowloon, roughly 5 million, and then Tuen Mun is around 2 million at the north. You may lose that 2 million population due to the closer border traveling. But if you live in Chong Guan, for example, if you live in Tin Hau, I don't think that's an easy way to go. So I think we're still able to capture domestic consumption within Hong Kong. But it's just that the F&B operators or tenants, they have have to, or brand, they have to offer variety of options to our resident here.
Fantastic. Thank you so much. Hannah Jeong there of CBRE, and of course here with us also in Citi is Crystal Chia, our Asia real estate reporter. And by the way, you can get an insider's guide to the money and people shaking up the finance hub in our Hong Kong edition newsletter that's out every Thursday. So you can sign up via Bloomberg.com/newsletters. Plenty more ahead. This is Bloomberg.
All right, take a look when it comes to Hong Kong markets here this morning. You continue to see HS Tech is heading lower. We're down about 0.9%, just still off some of the lows of the session, but we're still seeing some sizable declines. Alibaba certainly is one of the bigger weights on that, given this sort of concern around this U.S. crackdown on the likes of brands like Temu, Shein as well, and really the U.S. trying to close some of those loopholes about sending cheaper U.S. packages and all the like. H shares are also down by 0.8% here this morning, still reacting, I guess, to that weaker set of data that we got, and it was a big data dump, whether it was credit, home prices, as well as activity data for August as well. There you go, the developers further into bear market territory. We're down about 2% this morning. Let's talk about something else to look forward to tomorrow, which might bring some more, I guess, revival to this IPO market in Hong Kong. We're talking about Midea Group, the Chinese appliance giant, set to debut on the Hong Kong Stock Exchange on Tuesday after raising $4 billion. Let's get to Julia Fioretti, our Asia Equity Capital Markets reporter. She joins us now. We're hoping that this is really going to get Hong Kong back in the spotlight in some ways in the IPO market. What does this tell us about the state of play right now?
So it certainly will give Hong Kong a big boost just in terms of volumes. About only $2.5 billion have been raised so far this year. This obviously brings $4 billion, and it could go up further in one fell swoop. So it certainly tells us that it's getting a little bit of its mojo back. It's hard to say that this will open the floodgates or mean that loads of other deals may follow because it's quite a unique case. It's already listed, and so investors already know the company. It's not a new one that is still having to prove itself. So hopefully it will do well, so that then I think that's what everyone is hoping in Hong Kong, because they want it to do well, so that then it will pave the way for further deals, and investors need to make money.
And well, since we know about the company, it's nothing new. We know how oversubscribed the deal was. Can we take those two factors and say this probably does well in its first day of trading tomorrow?
It should do. Okay. All signs are pointing in that direction. As you said, it was heavily oversubscribed. Books closed a day early. It was upsized as well. So if it doesn't do well, that would be pretty disappointing.
What does?
Exactly. So all signs are that it should do well.
Yeah, and we've seen a lot of this, right? We talked about SF Holdings and how they're looking for maybe an H-share listing and the like. Why are we seeing some of these companies that are listed in the mainland also looking for a Hong Kong listing now?
There are a few reasons. One of them is quite simply that the mainland market is pretty much shut in terms of listings there, and has been for a while. And so Hong Kong, despite all its troubles, is still more open than the mainland. So one way to get overseas funding and offshore funding is obviously to come to Hong Kong. And many companies, Midea included, are looking to get more overseas funding for overseas expansion. And that's also as they seek to expand abroad, given the problems with the Chinese consumer back home.
Julia, thank you so much. Julia Fioretti, their Asia Equity Capital Markets reporter, as we were just pointing out there. So there's Midea, there's SF Holdings, and then also coming through, I think, is Core Tech, planning to spin off one of their units here for a list. So maybe this is that pipeline, of course, that HCAS has been telling us about, and maybe we're seeing it now. Plenty more ahead. This is Bloomberg.
All right, we're taking a look at, it is getting a bit gloomy there right now here. So Shanghai being slammed by this typhoon. Babinka is what they're calling here. And yeah, they're saying it's the biggest typhoon to hit the city since 1949. I was talking to some friends, and she says, you know, it really is sort of the equivalent of a T10 in Hong Kong in some ways right now. You're seeing the impact when it comes to some of these airlines in China, where they're talking about more than 600 flights that have already been canceled, of course, and this is just on the eve of Mid-Autumn Festival, where many people are trying to head home to have dinner with their families, too.
Yeah, tens of millions, according to, I think, Xinhua News reporting, that, you know, the number of people that they expect to get on the railway system because of the holidays. And on the back of this, to Yvonne's point, right, more than 600 flights. As of 2 p.m. local time on Sunday, Shanghai, in fact, the local government initiated a top-level emergency response to this, what you're literally seeing or not on your screens. And by the way, just for context, right, this is a view right outside our office window in Shanghai, the financial district, where you can barely see anything there in Lujiazui. Let's bring in Min Lo for more, of course, and to talk us through how bad is the damage we're expecting and we're seeing so far here, Min.
Yeah, as you said, it's the worst since 1949, the worst typhoon to hit Shanghai, and it's coming right smack in the middle of Mid-Autumn Festival, which is one of the very few longer public holidays that China has. And so economists were hoping that this would give a boost to consumption, to the travel and entertainment-related sectors. But just this morning, I actually received a message from my neighborhood committee in Shanghai telling people not to go out if possible, not to order food delivery if possible. So it's certainly going to hit the dining sector. There you go. Amusement parks, Disneyland is closed for the day. And Shanghai, as you said, activated the highest level emergency response yesterday. So they closed down the rail lines, the ports, the airports. Thousands of people have been evacuated. So this came after that extremely weak macro data we saw in August. And now this typhoon is coming just a week after Typhoon Yagi made landfall in southern China that had inundated farmlands and caused disruption to industrial production. So 2 typhoons in a month. Imagine that's going to hit the way on the activity data for September as well. And bear in mind also, a lot of local governments actually invested a lot of money to promote tourism, making use of this back-to-back holidays in September, the Mid-Autumn, and October, the Golden Week holiday as well. So, you know, it's disappointing for the economy and for the millions of people hoping to take a break this long weekend. Yeah,
this economy can't really catch a break, but of course we certainly wish everyone to keep safe and dry and safe during this weather system and typhoon. Min, thank you so much. Min Lo, getting us up to speed here. The strongest typhoon the biggest typhoon to hit Shanghai based on local reports here since 1949. A brief look at markets right now. Asia ex Japan is the gauge we're tracking today. Japan, on top of many other markets, are shut because of the holidays there, of course, and we're effectively flat. We're almost substantially lower on volumes, given that it's, of course, all the closures, plus, of course, it is, of course, Fed week as well. Global macro movers for you on your screens. Just to break down what the equity market story is looking like. We don't have trading and cash treasuries as well. Keep that in mind. Looking at some of the Fed fund futures, which trade, of course, somewhere else. The pricing right now is around 60% of a 50 basis point cut this week.
Yep, still not consensus, though. But definitely that debate is still up in the air. This is Bloomberg.